Hey, everybody, this is Bob and Phil, Trade Genius Podcast. Janet Yellen has single handedly been trying to hold back the floodwaters of the liquidity collapse. We're going to talk about how much time she has left and how long the market has before the collapsamundo. Stay tuned.
Trade Genius.
Hey guys, I want to tell you something that we do that really will change the way in which you look at trading and also absolutely help you increase your profitability and how much money you make. It's the Trade Genius newsletter. We put the newsletter out Sunday night through Thursday night, and this really looks at the plumbing of the markets and helps prepare you for the next trading day and help you make money. And we give you a lot of information. We give you market statistics, we give you market levels, we give you the seasonality, what's happening with different sectors of the market, and we will help you identify whether the market's in a bear mode or a bull mode, or whether it's euphoric, whether it's despondent, and it just puts you in a position to be on the right side of the trade. So take advantage of our offer that we have below, and you'll love it. I mean, one trade that you make with this thing can pay for definitely a month, maybe even a year's worth of service. It's that powerful. Use promo code podcast for 15% off the retail price of newsletter. Thanks for listening. Okay, Phil, you have all the charts here today, so I'm going to give you the mic and let's kind of share with people a little bit about, where this liquidity is coming from, even though they're still struggling to keep this thing alive. So I'm going to turn it over to you.
Yeah, so, we showed you guys liquidity. We're going to look at it again today, but we thought it would be prudent to show you guys how close we are to the fumes here in the gas tank. So let's flip over to this chart. Essentially, this line represents how much money is in the checking account for the government, right? It's the Treasury's General Account, or TGA. And as you can see, it's drawing down here, getting closer to zero. And we just put a channel on this just to kind of give you a trajectory. So if she continues on this pace, now there may be some tax receipts that come in, but let's just say it continues at this rate, we're going to be running out of money either at the end of the month or the first part of April at this rate. And we'll keep tabs on this and we'll keep updating you guys. But this is significant because this is, you can no longer run the government if we're out of money. And I know there's been some news articles in the last 24, 48 hours with, Congress, members of the Congress talking about, or senators talking about how dire the situation is getting. And what's going to happen is that they're going to have to get to that debt ceiling argument, and they might have to get to it sooner rather than later. Okay. I think they were thinking about dealing with it in June. I'm not so sure that we have enough time to make it till then. But why this matters is because as she draws this down, it helps support liquidity in the markets. So if we look at the actual liquidity, if Yellen hadn't been basically spending all the money on out of that TGA, this blue stuff would have been much lower. Okay. So what's going to happen is when we do get a debt ceiling, a limit passed, whatever that is, she's going to start issuing more debt. Now, when she starts issuing more debt, the account balance is going to look like what happened back here going from March 2020 up, okay? But it's also going to look like what happened going into the end of 2021. This is the more relative thing I want you guys to look at, because this was COVID craziness. This is more about issuing debt and driving the TGA balance up. When the TGA balance is driving higher like this, and that's what's going to happen, it's very negative for the market liquidity because there's really nothing else counteracting it. The Fed's not accommodating. The Fed's actually rolling off their balance sheet as well. So you're going to have the Treasury sucking liquidity out. You're going to have the Fed sucking liquidity out. And on net, the banks have been parking more and more money overnight at the Fed. So they're putting less money to work in it. And the banks know if both those guys are not putting money to work, then if they're putting money to work, it's just they're going to be swimming upstream. So better to wait. So you run into a situation what we had at the beginning of 2022, where that was basically the end of the bull run, and we started dropping back down, and that's what you can see here in the liquidity. So we're looking at a situation like this, where the blue just starts dropping off, and I suspect you're going to see this market follow it like that. And this is the part of the bear cycle we've been warning you guys about, and it's been dragging on, and the drop hasn't come, and you guys are being too bearish, the market's still going up. This has a very good probability of coming, and this is why we've been very defensive in what we're telling you guys as far as where this market could go. If you look at back over here now, you see that the liquidity is dropping on net dropping. And then I've also been asked about global liquidity. It basically looks the same way. The signals are the same. Both, if you just take a look at either the Federal Reserve's liquidity, net liquidity, or if you take into account all the central banks in that equation, both of them are risk off, okay? And this area here, this divergence looks a lot like August. You can see what happened. August snapped back down. The only reason why this hasn't dropped off even more is because Yellen is burning that cash and it's coming back into the system as liquidity. I won't get into the technicals of that. That's just how the mechanism works. So as you can see, our fair value is up here at euphoria levels. And typically, as you can see, that will rotate back fair value back down to zero. And that's typically where you get these waves down in this bear market that we've been persisting in. So tomorrow, Bob, we've got Powell speaking. You know, there's a lot of questions whether or not there's 25 basis points or 50 basis points. And he, you know, I kind of get the feeling from him, he's not impressed with the market, maybe calling their bluff, so to speak. I don't know, but they definitely feel like the market's not getting the message. And I think you and I both have seen enough data, and we've shared enough data on this show with these guys, that inflation is at the risk of getting entrenched here. So I was just curious your thoughts on that.
Yeah, and look, and let's just say that we're wrong and we get this big liquidity impulse higher. The cost of energy and the price of energy is going to go through the roof. Okay. And you saw it today. You know, they tried to do a 3-day lift here, you know, from that turnaround on Thursday from the Fed guys saying they're going to pause. And as soon as price started moving up this morning, oil shot up over $80 a barrel. And that's alarm bells for the Fed and for the administration, basically saying, hey, look, you're not going up without me. And if I'm going up, then we're going to be embedding inflation that's going to make things even worse. The other thing too, Phil, is the TGA. You know, a lot of times when they're talking about June and July is because the government gets a big influx of revenue in April because of the quarterly filings and the annual filing deadline. But this year is a little different. So in California, we just got notified because of all the counties that are being hit with these winter storms and the rain that we had. Basically, almost nearly every county in California gets to delay making their payments and filing their taxes till October of this year. And I think there's a few other states that are in the same boat. You know, that just delays money coming into the Treasury into the fall. So what happens if the Fed runs out of money, what they do is they spend what they have. So money's always coming in every day. So it's not like it doesn't show up until a certain month or a certain week of the year, is that they literally will match payments to the income coming in and they prioritize everything. So you remember, this is where they kind of make you feel bad by closing the National Park Service, or we're not going to get you your passport, and
Right.
you know, so you can put pressure on your Congress people. So, but what it'll do is it'll actually incredibly shrink in economic activity. In addition to that, she just won't have any Yellen bucks for the banks to throw into the stock market. So whatever games that they're playing behind the scenes, and I guarantee you they're playing games behind the scenes. The Treasury's out there buying and selling calls. The Fed's out there buying and selling calls. No matter how much they tell you they don't do it, they have proxies that do it for them,
Right.
that they lend them money and it's done on their behalf.
Right.
All that goes away because there's this, you're at the casino and you ran out of chips.
Mm-hmm.
And the casino window is closed until they can start borrowing money again. So it becomes really, really real. And the other thing too is, even without all this stuff, it's just you're seeing, if you look at the consumer, all the consumer companies are falling. So, you know, people are now just buying what they have to buy. And with the price of everything, it's just getting so expensive, people are just simply deferring purchases.
Right.
And so, you know, this is going to fall by its own weight. But without this artificial stimulus that the government and the Fed and the banks push into these markets, you know, we're probably 20-25% overvalued. So our expectation is by the time March ends, we're going to get a pretty good push down. And then if we run into a year scenario, Phil is saying they run out of Yellen bucks in April, then, you know, then we can look at a 30, 60, 90 days of turmoil. And I'll make one last point politically. The House Republicans will not easily concede. They were told this is why you were hired, and they're going to hold the fort because they feel that their position is strong in terms of, you know, political electability, because these people all survived, you know, multiple years of basically political abuse. And so they probably feel that they're in pretty good shape here. And I think they're going to hold the fort here longer than the Biden administration will want them to. And then you'll get some sort of, obviously, you'll get some sort of accommodation, and then liquidity will pour back into the markets. And then Phil and I will be singing a different tune for 60 or 90 days before we get onto our here comes fall and we're going to crash mode. So, so you'll get a reprieve from the doomsday boys, but we'll be long with you.
Yeah,
you know, we like money as much as the next person.
Buy all the things, right? Yeah, I agree with you. And we've been saying that for at least more than a month, that this current cast of political characters could actually produce an impasse for once. I don't think we've ever had an impasse on the debt ceiling. It's always, at the very least, it's been at the 11th hour or whatever. But that's my prediction, was we had a very good chance out of the last 10 years of this time being different. So we'll see. I'll leave you guys with this, though. Going back to 2022, you see the blue line is basically Yellen's checking account. You know, preceding this blue line jumping up here, what happened was she was on fumes again. We're heading like the situation was here going into the end of 2021. That's the situation we're at here, okay? And this red line represents $0. So what happens is she's going to have a bunch of debt to reissue. It's going to drive this up. But you notice this orange line I put on here, this is the S&P 500, the SPX, the stock market. And so you can see as that drives back up, and it's going to drive back up because she's going to have to play catch up. This might drive up harder than this time than back in 2022. She has a ton of debt that she's going to have to issue. It's going to drive the market down. And that's why we're saying, second half of this year is going to be pretty harsh. And, if the recession indicators are any tell, they'll be officially telling us we're in a recession at that time too. So hopefully this clears up kind of the what we've been talking about in the warnings. And now you guys can kind of see the mechanism at play here and how it affects the stock market. And, again, you want to be careful and be defensive and look at those ways that you can hedge your portfolio. And if you're interested in more details with that, you can always join us in the room. Check out our specials, check out our newsletter, tradegenius.co, and you can stay on track with that with us.
But one last thing, too, for people to realize is when Yellen starts to issue bonds again, is that the bond market yield will go higher, which is also negative on the market, too. So we're going to get some double and triple whammies here, headwinds against the market.
Great point. Yep. All right, guys. Well, that's going to do it for this video. Let us know your thoughts. How are you preparing for all of this as we go into the second half of 2023? And leave your comments below. We'll love to read them. All right, guys. Thanks for watching. See you on the next episode. Take care.
Trade Genius.